Climate change, finance sector development, navigating climate risk, the crucial role of insurance in the transition to a low carbon economy. Insurance can bring their expertise on risk awareness to the climate challenge. This photo is captured by Damon Lam by Arup Kumar Chatterjee. The insurance sector can be a game changer by managing risks from climate change in Asia and the Pacific, protecting ecosystems and supporting the shift toward a suitable future. Climate change in the defending climate change is the defining challenge of our time as Asia and the Pacific produces about half of global greenhouse gas emission. If no action on climate change is taken, the region's current GDP may shrink by 26.5% by 2048, says Swiss Rich Climate Economies Index. Our region also can economist catastrophe protection gap, the difference between optimal and actual insurance coverage. It averaged 32% compared to the world average of 58%, burdening public budgets, businesses, and households. Climate risk manifest in two ways. First, physical risk can damage properties and disturb supply chains to cause enormous losses to economies, exacerbated by a lack of climate risk mitigation infrastructure and other capacities. Second, the overall shift in policy, technology, and market sentiment raises costs, reduces incomes, and strains assets amid transition requirements to a low carbon economy. Both physical and transition risks impair assessed value and credit quality of loans and investment from banks, financial institutions, insurance, and capital markets. In the absence of appropriate counter-cyclical financing mechanisms like income smoothing social safety net. In the absence of appropriate counter-cyclical financing mechanisms like income smoothing social safety net and public insurance schemes, this can create sizable implicit contingent liabilities for governments. Yet governments have been slow to integrate climate risk and its threat of financial system into their decision making and strategies. As societies risk managers, insurers have a critical role in the web of climate change complexities, providing financial stability in the process. The industry is uniquely qualified to assess and price risks through differential premiums and setting deductibles. Price signaling can incentive policyholders policyholders to reduce risk and limit in the impacts of extreme weather. For example, homeowners might fortify their roofs to typhoons and thus pay a lower premium or face a lower deductible. According to International Energy Association's projections, solar, wind, hydro, biomass, and the like will provide 49% of global electricity generation by 2050. Yet the risks keep growing. Insurance offers coverage opportunities for the entire life cycle of renewable energy projects, providing underperformance guarantee insurance coverage can make renewable energy projects more bankable. Inclusive insurance can hasten recovery and boost resilience by providing financial compensation or shock responsive social protection. For example, vulnerable women working in extreme heat can receive payout when temperature hit a predetermined level over a predefined period. The insurance policy can pay out multiple times to compensate for missed work during those heat waves and warm spells. In the agriculture sector, insurance against multiple risks can contribute to the overall cost effectiveness of crop insurance schemes against climate related risks. These plans could include insurance for crop loss, discounting premiums for farmers who invest in climate resilient measures, and starting shared insurance funds of government backed insurance. The insurance industry is likewise moving to protect endangered blue natural resources. On coast, mangroves and coral reefs can cost effectively reduce flooding. The industry is starting to use innovative risk transfer schemes to conserve and restore natural ecosystems, including the Hindu Kush Himalaya. We must nonetheless bear in mind that climate-related risks pose an imminent threat the sustainability of insurance operations. The insurance sector in emerging market face significant headwind in assessing capital and data. Taxonomy regulations, standards, and best practices remain nascent, weak, defined, and unharmonized. These factors, insurability of policyholders, assess the income and insurance operations and investment.